it is scary stuff. I don't think it should affect what you do in stocks, but in terms of the human race, it's scary stuff when you have a pandemic.
Yeah, I guess this one's particularly frightening because it's new. So there's no natural immunity that's built up in any of the populations. And you wonder what happens, particularly in areas where there's not the same healthcare structure that we have in America or in some of the developed nations. I guess that's a big part of the question, too.
Yeah, and well, I think about it in terms of our annual meeting. I mean, which is May 2nd. I mean, it could very well affect, by that time, it could affect.
We got questions from viewers asking just that. Will the annual meeting be any different this year, particularly because you have a large Chinese contingency of shareholders who are here for that?
Yeah, and that certainly will be affected. And incidentally, I mean, flu is particularly tough on old people. If you're going to have two guys on the stage whose combined age is 185, so we won't be looking for people that are showing any signs of contagion.
On pace for the worst day since last August, when trade fears really hit this market. The global sell-off is what's really contributing to the momentum here on the downside. Among the worst performers today, obviously over in Italy, where they saw a big spike in the numbers, and as well in South Korea. Those are two of the biggest outbreaks outside of China. The big tech firms, first of all, are the largest decliners this morning. They have large exposure. Certainly Apple, we know about. Tesla, which says that its Gigafactory, right now not a big contributor to revenue, so it's not really going to have a big impact. But you've got to wonder about Tesla's auto sales in February, with things pretty much just at a standstill throughout much of China for most of the month.
Taking a look at damage control amongst my different accounts in my six-figure dividend stock portfolio being down $5,000 to $6,000 today. That is more than most people make in a couple of months. I'm going to give you my opinion on what is doing the best, what is doing the worst, and where I think it goes from here, starting with my RRSP, my Registered Retirement Savings Plan, which has seen the biggest hit by far, primarily due to Facebook stock. And Facebook being one of these top tier tech companies, it is performing the worst against, say, Apple and Microsoft today, being down 5.29%, which came as a bit of a shock to me, considering most people on quarantine, the fact that people aren't going out. You think they'd be spending more time on their social media platforms, spreading all that fake news. On top of that, we have a political cycle coming up with people like Bloomberg spending tens of millions of dollars on Facebook ads. So I think when we head into the first quarterly earnings, Facebook is going to be one of these stocks that shine against all these different companies like Apple, where people aren't going into the stores as much, things like Carnival Cruise Corp, things like, any kind of resort-based stock, just because those are obviously going to be getting the most affected by this virus. Taking a look at the other stocks being affected in this account, Tesla not down as much as I would have expected in retrospect to how much it is up. I think it's only down 7 or 8% today, nothing to really, worry about. Johnson & Johnson down as well. And that also comes as a bit of a shock because you think healthcare sector stocks would be doing much better, especially considering the news that's going on with this virus. And if it dips any lower, if I see it start hitting that 140 mark, I am going to consider buying a little bit more to kind of continue building my healthcare sectors. Now, why are these kind of S&P top tier companies down? I think it is primarily due to the fact that people are pulling money out of ETFs. When big money comes out of ETFs, all these stocks are going to be hindered. Moving into the tax-free savings account, where I've seen some pretty big dings as well. We'll start with the Canadian sector and then we'll move into my U.S. stocks. But taking a look at my financials, we got Bank of Nova Scotia, we got Canadian Imperial Bank, relatively flat overall. These banks haven't done anything for the last couple of years except trend sideways, especially with Steve Eisman, kind of shorting them. But overall, I'm fairly happy with these. My best performing Canadian stock by far, Northland Power. And I think it's doing fairly well just because it's not exposed to these like large weighted ETFs. So when big money pours out of the ETFs, it's not really being affected by that. And it is just my only green stock today. But overall, the position's up almost 40%. Absolutely incredible stuff with this guy. I'm not buying any more of it, but it's nice to see that the position is worth about 16,000 Canadian dollars as of this very moment. RioCan, my real estate stock, just trending flat. It's not doing too much. I plan on adding some more capital to this over time, but not yet. I did spend my dividends, mind you, and I'm going to share with you in a second what I just bought with those dividends. But taking a look, MO taking a beating today. MO is one of these, my sin stocks, one of my favorite sin stocks. If it continues to dip lower and we see it drop closer to that $40 mark, I am definitely going to be buying more of it. I'm fairly weighted in the position amongst all of my accounts, which we're going to see in a second. I own about $20,000 to $25,000 worth of MO and BTI combined. They are my largest weighted positions so far, I do believe. But Apple here also taking a major hit. I mean, it was hitting a high of $320, $330, and today we're seeing it sit right around that $300 mark. There was a lot of speculation yesterday based around the futures in the market because everyone saw what was coming, and there was a lot of people thinking that Apple was going to open up at like 250 to 260. We did not see that happen. So, I mean, it's holding up fairly well overall, but like I said, we'll have to wait for the first quarterly earnings to come in where we'll get to see the full fruition come into play on this virus. The stock that I recently bought, though, is my wonderful GEO group, my prison stock. I just bought about $300 worth of it literally just a few hours ago. I think it is one of my favorite stocks by far, even though I'm down so much on it. I just love their balance sheet. I love where they're going, and I think it's a very underrated stock, which is going to be very affected by the political uprunners, because we all know politics plays a big game in prison stocks. But overall, I really love the company, really happy with where it sits and where I think it's going. And then there's Microsoft also being hit today, down 172, which is a pretty big drop overall for Microsoft. We got Southern Company, another one of my utilities, not nearly as badly hit. It's actually holding up quite nicely as well. So far, the best performing stocks in my TFSA are my utilities, being affected the least, which is a pretty understandable thing. I mean, everyone's got to keep the lights on whether they're infected or not. Like, these utilities are going to operate under any conditions, which is why I love them for dividends, especially considering Northland Power pays me over 5%, and it's just been on an absolute tear as of late. But moving into my other accounts, I mean, I do hold a lot of MO in my managed account where I'm also seeing some pretty negative effects right now, down 10% overall, but I mean, that only equates to a couple $100. Nothing too severe here. Taking a look at my other account, my final account, which is my RBC account. This is where I hold my most recent purchases. Again, here I hold more BTI, more MO, and my more recent purchase, Wells Fargo, which has been taking some pretty big hits, but I think that's just because it's heavily weighted, again, in these index funds. I do plan on buying more Wells Fargo in this account at some point. I do have some more capital built up as of right now, but the problem is we're just heading into tax season. I'm going to be doing my taxes this week, and once I figure out how much I'm going to owe the government, once I pay the accountant their absurd fees and their advisory fees, because I do ask them a lot of questions as I work for myself, I'd like to get all that resolved before I start funneling in large amounts of capital into the portfolio. I am sitting on a couple $1,000s just in cash right now, but like I said, I'm just heading into a really busy season. As soon as March comes, my job really picks up, and I'm going to have a bit more extra expenses until those large checks come in. So in the meantime, I'm just going to really take it easy here, moving farther into the market. What I'm hoping is going to happen overall is that we see the S&P take a bigger hit. I mean, we haven't seen any major correction. The last time we saw it was at the beginning of 2018 when the markets dropped from all-time highs down 10%, and then we saw it again mid-September going into 2019 where we saw another about a 13 or 17% correction. It would be really nice to see this happen again. I know most people don't like seeing their portfolios drop, but in the macro here, guys, as primarily a dividend investor, I have my growth positions fully built out. We're talking Facebook, Apple, Microsoft, and Tesla. I'm going to leave those ones set and ready. I'm not buying any more of them. So it'd be nice to see the markets correct so I can continue leveraging into my high dividend yielding stocks like GEO Group, which pays out 11% as of right now. Wells Fargo's paying out 4.5%. So, I mean, this is the prime time to be averaging into stocks. Taking a look at the Shanghai composite here, guys, I am absolutely flabbergasted by what is going on in the Chinese markets right now, considering when the first bit of news came out and all this crazy lockdowns going on, the Shanghai composite dropped by around 12%, just under 12%, maybe a little bit more if we go up to the top here. But now all of a sudden it is coming back with a vengeance. So I don't know what the heck is going on, considering it is up 10%. Let's just take a look at the last day, considering it's only down about 0.28%. It's actually down less than the overall U.S. stocks. But if we take a look at some of the individuals, we can see Baba's down 3%. You got Tencent that's down another 2.6%. So I'm really curious to know if you guys understand what is holding up the entire Shanghai composite. So it's kind of a fascinating little correlation that I've noticed, but I would like to know what you guys think about all of this in the comment section below. What do you think about my personal holdings? Do you think my holdings are going to do just fine? I want you to keep in mind that that overall my stock portfolio is still up substantially this year. If I take a look at my charting that I write down, we started the year at $130,898, and we're currently sitting right around $146,000. So yeah, we are down about $5,000 or $6,000, but overall on the year, we are still up pretty substantially. Now, that could change drastically depending on how my tech stocks perform, because we all know in kind of volatile times, your growth stocks will perform the worst by far, yet Tesla's still holding up. You know, all these stocks are doing fairly well, but we'll see what happens as things go forward. But you know, I'm just getting a cold too. I've been kind of holding back, doing a lot of cut edits here, so I've been sniffling a bit, which is kind of ironic, talking about a coronavirus. Not that I have that up here in Canada, but I do think I have a regular cold. But stay cool, stay awesome, guys, and I look forward to chatting to you real soon.